My name is Joe Schorge. I am the founder and managing partner of Isomer Capital.
So Joe, Isomer Capital is a firm backing European technology, mostly through commitments into funds, but also you do co-investments and secondaries. And so tell us a bit about your kind of outlook for SuperVenture this year. We're here in the first day of SuperVenture. What are you hoping to get out of this event this year?
Well, SuperVenture, as you may know, is the biggest collection of GPs and LPs in the venture community every year. And so for me, the most important thing is I can walk down the hallway and catch up with half of our portfolio and a very big part of the ecosystem in one place. And that's really nice. It's a bit overwhelming sometimes. You can't take one step and you meet three people, but so that's efficient because, you know, to have 100 Zoom calls takes time, but to have 100 conversations over 3 days is great. Of course, there's some real work that gets done, moving deals forward, finding out about new deals. Every year there are different trends that are hot and so on. And so this year, I think a lot of people are interested in secondary sales. We're a buyer. So that's, you know, this year in particular, quite a topical thing to find some deals, to create deals. You know, hey, have you ever thought about, you know, this kind of thing?
Do you want to talk a tiny bit about secondaries? What are you seeing? What's getting you excited? You know, Isomer recently launched a secondaries fund. Give us a quick rundown of how you're seeing things there.
Yeah, we've always done secondaries since the day we started, but we've done it in a soft way by telling our partners, if you ever have an LP or a founder or, you know, someone seeking liquidity, let us know. And that was a fairly soft approach, which worked well, but also fit the style of the market, which was in total growth mode. And now, sitting here in 2025, what you find is the biggest stock of assets in Europe that's ever existed, of tech companies, right? Not enough DPI and lots of people interested in liquidity. So what are we seeing? People saying, oh, well, could I sell? Well, what do you have? What are you selling? So it's gone from a fairly passive, special situation, somebody might need to sell, to now actually quite a large part of the venture ecosystem, from founders to VCs to LPs are thinking, could I sell part of my, I have a lot of gains on paper. That's the good news, right? If you didn't have good gains in Europe, you wouldn't have anything interesting to sell. So the good news is we have amazing gains all over Europe, great companies, great funds.
But you can't buy a coffee with gains on flavor.
You can't, you know, what my favorite expression, it's not a return until you can buy beer with it. You know?
There you go.
So,
we still need some money to buy beer.
You can't eat IRR.
Exactly. Well, on that note, you know, you mentioned DPI, right? One cannot not mention DPI when talking about secondaries. You had a fireside chat on stage a couple of hours ago with our dear friend Bjorn, who will also be recording with us. This is something you guys do recurrently, I hear, and we're just chatting about it before starting the recording, but it connects very well to this topic of liquidity. Do you want to give us a quick rundown if one of our watchers or listeners hasn't been at this edition? Give us the quick highlights of the session.
Yeah, what Bjorn and I like to do once a year is to really reflect on the prior year. What's happened? How does that fit what our expectations were last year? The benefit of talking to an old friend once a year in that formula way. You can say, well, we were sitting here a year ago expecting exit markets to reopen because we'd had second half of 22, all of 23, first half of 24, not really much exit activity at all. And so, you know, what I was not too pleased to say is it's remained closed. I think Q4 we saw a lot of pickup. So we have had exits in Bjorn and EIF's very big portfolio. We've had some small exits, but it really, the macro uncertainty, particularly the tariff scare by Trump, has caused people who might normally acquire companies to become uncertain about the future and put off acquisitions. The IPO window stayed mostly closed. So that wave of exits is yet to come. I think it will. But what we know is venture needs time and venture needs macro stability.
Yeah.
And so that was a lot of what we spoke about today. We have a lot of optimism. I think that's also a feature of whenever I talk with Bjorn in that way, we're optimists. That's why we're
That's
in
why
this
you're
business.
venture, yeah.
When you look at the underlying portfolios, wonderful company growth,
Yeah.
super products, global customer base. So that's the bedrock that underpins everything, and that's really quite strong. So the question about exits is a question of when,
Yeah.
and not, and of course there's always the question, what should I sell my company this year for one, or shall I sell it next year for two,
Yeah.
or 1.5?
Yeah, whatever.
Yeah, so there's that time arbitrage.
Yeah. You said something interesting, and we're not going to dwell on politics, of course, but venture needs macro stability. How do you look to the future? How are you feeling? Thinking about Isomer and your deals and what you guys focus on when you see the overall macro. Are you optimists? Do you think it's going to be stable enough for venture? Do you fear anything?
Well, of course I'm an optimist. We know each other well enough to know the answer to that, but the world is not using fewer technology products, right?
True.
There's not less tech in the world. And fundamentally what venture is doing is helping innovation get off the lab bench and into use by society. So on a very big macro level, what we do is needed more and more and more. So I don't see any end in growth for that. But of course, capital markets are cyclical, and that causes cyclicality. So I'm very optimistic. I think we will have exit markets open, and our portfolio in particular, but I would say many, probably most around Europe, have generated companies doing 100 million or more revenues. They're kind of ready for acquisition by trade buyers or even private equity community. So I do believe that once certainty comes back, stability comes back, you will see a lot of exits coming. And it's funny because it looks like it happened all in 1 year. It was 10 years of building prior that leads to that moment. But as an investor, you've got to be in it to win it, right? And it's no good looking back and go, oh, what a shame, I missed that amazing. I missed Spotify. You can be in the Spotifys of tomorrow by backing venture capital today.
There's always appetite to sell to some extent in any industry. You mentioned the tariff situation. How have you seen buyers' appetite evolve this year?
There aren't many buyers in general, so there are the hidden buyers, I would say. So late stage investors coming in, doing a growth round, buying founder shares to give founders some comfort, or buying early. So that's always a low level of secret activity that's going on, that continues. There are more direct VC buyers, so direct secondary funds in Europe, and that's needed and welcome, and a great feature of the market. They build essentially a basket of venture assets, but with a closer exit horizon. And then there's our fund, which I think is one of the first in Europe that focuses more on the LP side. So providing liquidity to LPs who want to, this kind of classic situation. A VC is raising fund 3 or 4. They haven't had enough liquidity out of fund 1 or 2. And so that becomes a really interesting purchase for those who are able to enter, and it provides a nice form of liquidity, which then can be recycled. So in a funny way, some of the government investors see secondaries as not helping. It's not money going in, it's circular money, but actually you need it to have a mature capital market, right? And that secondary, what we hear again and again, I like to ask the sellers that we buy from, well, what are you going to do with this? And again, there's a lot of house buying for founders and so on. But again and again, people turn into angels. People recommit to new funds. So quite often when you see these sales, it doesn't represent someone leaving venture. It represents someone taking some profit on a good investment and then moving on with their portfolio. It's
exactly what we've seen across Europe, right? Every single mature ecosystem, we've seen that happen because they were first exits. It's just a different type of liquidity moment. I'm gonna shift to how I'm hoping to wrap up every single one of these conversations, which is asking maybe a bit of a curveball of a question, but What have been your biggest learnings in venture? Not necessarily in the last year, but recently.
That's a big question, David, because, you know, venture fanatics, we love to study it and try to find patterns and learn. I guess we're all learning and forced to learn. Venture building companies takes time. So venture capital is building companies, you know, putting the capital in the build, and that takes time.
Yeah.
And you don't always like to be reminded of that, you know, when you've been holding an investment for 8 years and you're ready for that capital to come back. And so I don't enjoy that feature any more than anyone else. But what I do think is, so long as you're seeing growth in that asset, that you may exit a bit later, but if you're exiting at higher values than you bought at, you're delivering a good return. So yeah, that's a tough learning. You know, venture takes more time than you think. It's what people joke about, but it's a hard learning. I think the other hard learning for early stage investors is your predictive power at the very early stages of a business is very small.
Yeah.
You know, and so you always hear people talk about the founder is everything, because that's kind of the only thing you can study. Yeah. You can study a big addressable market, you can study an early product and so on, but there are so many twists in the road that the earlier you invest, the more uncertain the success is.
Yeah.
And I see it again and again where if you look at a portfolio of companies or pick a group of companies and you predict what will be the good ones again and again and again, VCs say it, this is nothing new, but the one I thought was going to be amazing actually died. And the one I thought was a really dumb idea turned out to be
amazing. Yeah.
the new Decacorn, right? And so I've been hearing that story for 25 years.
Yeah.
It's not a new story.
Yeah.
And what it leads me to conclude is that anyone's predictive power at that very early stage is low. So therefore, diversification is critical. If you diversify well, you will capture a bunch of big outcomes that compensate you for this uncertainty. That's the game.
Yeah.
It's one of those things that you can read about it and it's in every blog and textbook, but until you live it, it's that's where the learning comes from.
Yeah. So I'm going to ask you an unfair question, but just, thinking that some of our viewers and listeners might not be the venture geeks that we are, and hearing you talk about predictive power might raise some questions, right? So does that mean that I should only, if I am to invest in a fund, I should only look for those with very wide portfolios? Does that mean that I should not invest in industry-focused funds? Is that what you're saying? I know it isn't. So do you want to just develop a bit more kind of how, given that fact, lack of predictive power, power law, of course, we all know it, some words of wisdom for someone listening in who's thinking about venture but hasn't really ventured into it yet?
Yeah, what do I mean by predictive power? Anyone who's been investing in anything has developed a conviction about, I really like this stock, or I really like this entrepreneur, or I really like this fund or whatever. And the biggest comfort in the private markets, the biggest comfort you can take is in a track record. So here's a firm, pick your firm, buyout, real estate, whatever. They've had 5 funds in a row that have delivered great returns, so I'm going to invest in number 6, right? That's the kind of, you feel like you have a good predictive power. Of course, you have to see, is it the same team? Is it the same strategy? Is it the same market conditions? All of that. But that's what I mean by possibly your predictive power is a little more about fund 6, right? Yeah. And in buyout investing, you're buying companies that are EBITDA positive and profitable, and so there's a lower risk that company will fail. Early stage companies are in a way all an experiment. I think if you and I dream up a big idea right now and we create a company, we're doing that on the assumption there's a market for that. Yeah. Hey, if we create a better mousetrap, there's a whole lot of people who want to catch mice, right? And the issue, the predictive power issue is, well, there could be other people dreaming up mousetraps. There could be not as many mice in the world as we think. There could be not as many customers who want this solution, blah, 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 blah. So some of it is about the product and the founder. Some of it is about the market. Some of it is about time. It's interesting to think about what AI can do today. And it makes me wonder if your Fund 3 companies are going to disrupt your Fund 2 companies. because AI is now performing tasks that a pretty short time ago, you had a team writing software, and there are AI coding systems that are looking pretty good.
Yeah.
So, you know, there's an example, right? When you might have invested in a basic software, you might not anticipate that 5, 6, 7 years later, the whole hurdle, barrier to entry would be eliminated by a technological development. So anyway, I don't know if that's a good answer to your
It's a great answer.
to your question, but
It's a great answer. Let's build some mousetraps.
if you, I think if and what I've observed in all kinds of different portfolios is when you pick a group, of course you must pick that group that every individual investment could be great, but only 10 years will let you know which ones are great. And so if you pick only one, you have a binary outcome.
Yeah.
If you pick two, you pick 10, right?
Yeah.
So that's portfolio theory.
Yeah.
Don't
Yeah.
pick one stock,
Yeah.
either in the public markets.
Joe, thank you for joining me here in the filming studio at SuperVenture 2025. It's always a pleasure to see you and talk to you. I hope you have a great conference, and we hope to see you here next year, maybe.
Thanks, David. I've only missed one so far.
Oh, really?
Yeah, because of pneumonia, but I will see
Fair
you
enough.
next year. See you next year. Thanks for having me.
Pleasure.